Hi everyone, this is Gokul. Welcome to Logic and Lays. People, every time RBI meets, millions of Indians wait for one thing. Is my loan gonna get cheaper or not? Well, the October 2025 MPC meeting just ended. The repo rate is unchanged at 5.5%. Growth looks strong. Inflation is at record lows. But before you think this means celebration, let's peel back the layers. Because what RBI didn't do is as important as what it did. People, this MPC meeting focused on two major things. One is growth, other is the inflation. As far as growth is concerned, as per RBI, India's economy grew 7.8% in Q1. RBI now expects the economy to grow at 6.8% this year and 6.6% next year. Why so confident? There are three major reasons to it. A good monsoon supporting the rural demand and the GST 2.0 reforms that improving the domestic consumption and the continued government capex and the higher capacity utilization, meaning the people are spending more, government is still pushing heavy infrastructure projects, and the companies are investing to expand the capacity. Think of it this way. After 2 years of global uncertainty, India's growth engine is running smoothly, powered by the domestic consumption and the stable investment. That's why RBI sounds so optimistic on the growth side. But the growth is only half the story. Now let's come to the inflation. Headline inflation right now is unusually low, just 1.6% in July and 2.1% in August. Why? Because food prices, especially vegetables and pulses, dropped like crazy and the last year's numbers were very high. This is what economists call as a base effect. Imagine last year tomatoes were priced like 100 a kilo and now they are 50. Compared to the last year, inflation looks negative, but that doesn't mean prices will keep falling forever. It just looks low because the last year was so high. So RBI projects the inflation to average around 2.6% this year, and they also wants that it can go up to 4% in Q1 and maybe around 4.5% in the next year. In short, inflation looks soft now, but it may rise again. So, with inflation this low, why didn't RBI cut rate further? To understand that, let's look at what already had happened this year. In January 2025, repo was around 6.5%. It dropped to 6.2% in the February and March, and to 6% in April and May, and finally to 5.5% in from June to till now. That's a full 100 BPS cut in just 6 months. That's a very aggressive move by RBI. But these rate cuts take some time to show up in the economy. Banks need to adjust the deposit rates and the lending rates gradually. That's why RBI is passing now to see how these earlier rate cuts ripple through in the economy. They are basically saying we have already fired a big part of the bullet this year, so let's wait and see the effect before pulling the trigger again. So, waiting for the effects of the past rate cuts is not the only reason RBI has chosen a neutral stance. There's another layer to the story. External risk, global tariffs and exports. People, you might have already know the US has raised tariffs, which makes Indian goods costlier abroad. If exports fall, India's growth slows. A weaker export often puts pressure on the rupee. A weaker rupee means imports like oils and electronics gets more expensive and adding to the inflation. Second one is the oil prices. India imports more than 80% of its crude requirements. If global oil rises, petrol, diesel and cooking oil prices goes up. That doesn't stop there. Transports costs gonna get higher, food distributions become costlier, and this inflation spread across the economy. People, as we saw earlier, a good monsoon is one of the primary factor for the growth of the Indian economy. Now, what happens if we have a bad monsoon? A bad monsoon or flood directly hit the food supply. And because food has nearly 45 to 50% in the India's CPI basket, which means the inflation basket, even one crop failure can spike the headline inflation very quickly. This is why RBI is cautious. Growth looks strong. Inflation is low today. But if any of these shocks hit, inflation could climb fast. And that's the real reason for passing now. RBI wants to keep some space to raise the rates later if needed. It's like holding back a few arrows in case a bigger threat appears. So, alright, enough about the policies. What does it mean for you and me? First thing is the loans and EMIs. Floating loan borrowers have already seen a lower EMIs since January, but don't expect more big cuts soon, because and it's better to pay down expensive debt right now. Regarding the FD and savings, right now with inflation so low, your fixed deposits are going to give you a good real return. But FD rates may increase if the inflation rises. So locking some money now in short to medium FDs makes sense, while keeping part flexible to reinvest later when the rates move up again. And the third thing is the purchasing power. This is a sweet spot. Low food inflation plus GST reforms. This is the good time to make necessary purchases, but don't go overboard with the EMIs. And regarding the big budget items, fuel and food. People watch the fuel and food inflation because they are the first to reflect the global shocks. So, to conclude it, India's economy is resilient, growth is strong, inflation is low as of for now. RBI is passing heavy after heavy cuts, keeping an ammunition ready for the future. For households, this is a breathing room, but keep in mind this is not a free pass. Reduce expensive debt, keep buffers, invest smartly, and always track inflation trends. And here's the interesting part. While RBI decision saves interest rates and inflation, there's another powerful force moving our markets every single day. This the tug of war between FIIs and DIIs. Who really control the Indian stock market? And why do their moves matter so much to your portfolio? And that's exactly what we will decode in our next video. And that's it from my side today, guys. Subscribe to our channel Logic and Layers, and let's keep peeling back the layers one video at a time. Thank you.